Traders have experienced this. You enter a position, place your stop loss exactly where the textbooks say you should, and watch as the price plummets, hits your line, and instantly ricochets back in your intended direction. It feels personal, but the market isn't maliciously targeting individual retail accounts. It operates mechanically. Algorithms are simply seeking out dense pockets of liquidity to fill massive institutional orders. This chart highlights a classic vulnerability. When you place your horizontal stop price exactly below the structural support of a red candlestick, you are effectively serving your capital up as liquidity. This creates what is known as a liquidity sweep. The price is pushed just far enough to briefly pierce that obvious support level, triggering all those resting stop orders before reversing the trend. Relying solely on structural support lines for your defense places you directly in the crosshairs of routine market noise. The standard advice given to beginners to fix this problem is to use a strict fixed percentage for risk management, like a hard 1 or 2% stop on every trade. But as this diagram illustrates, arbitrary stops fail. The crossed-out ruler shows that a fixed percentage model acts entirely blind to the unique behavioral profile and daily fluctuations of the specific asset you are trading. A 2% drop in a low volatility forex pair signifies a massive macro trend shift. That exact same 2% drop in a highly volatile crypto asset is just standard background noise. Survival requires a dynamic buffer. Your stop placement must be dictated by current mathematical market volatility, not arbitrary percentages. If you do not dynamically adjust your risk to account for an asset's unique breathing room, you increase the likelihood of premature exit in noisy environments. This displays the average true range, or ATR. It's the standard for quantifying market unpredictability, represented by the orange volatility line. Notice the ATR is non-directional. It doesn't predict if a trend is bullish or bearish. It strictly measures the intensity of price movement. Standard high minus low candlestick measurements are mathematically insufficient for capturing your true market exposure and risk. This graphic demonstrates why true range is superior. Instead of just measuring the standard high-low span, it factors the distance between the previous period's close and the current period's extremes. This accounts for sudden gap-up and gap-down scenarios occurring overnight or between trading sessions. By integrating gap data into a rolling average, ATR provides the only historically accurate metric of exactly how violently an asset can shock your portfolio. Markets do not move uniformly. They transition continuously through shifting regimes of volatility that require constant tactical adaptation. This chart contrasts two environments. On the left, a low volatility regime with tight gray candles means you need tighter stops to identify a broken structure. On the right, high volatility. These wide, erratic swings demand significantly wider buffers just to survive normal intraday chop. To adapt to both, we use the dynamic invalidation formula. First, locate your structural anchor, the swing low or swing high. Then, subtract or add the ATR value multiplied by a specific risk factor. This formula scientifically separates a routine liquidity sweep, where a wick merely tests your anchor, from a genuine structural invalidation, where the body of the candle actually closes past your ATR-defined buffer. The ATR buffer establishes a mathematical boundary. It gives a valid trade the space to fluctuate within normal market noise, while providing a clear exit point when the underlying structure is truly breached. Your ATR period and multiplier settings must be precisely calibrated to your specific time frame. As this table shows, a scalper using a 1x multiplier cannot use the same parameters as a swing trader relying on a 3x multiplier to capture macro trends. You can apply this logic to the Chandelier exit variant. By hanging a trailing ATR stop from the highest high of a trend, you lock in profit while still granting the asset the precise volatility-based breathing room it needs to run. There is also the momentum variant, where entries trigger only when an expansion in ATR volatility aligns perfectly with a momentum indicator like the RSI. For institutional-level pullbacks, you combine the volume-weighted average price with ATR bands. This creates a dynamic defense line that continuously adapts as price action fluctuates. These variations demonstrate how ATR scales across diverse systems. By quantifying noise, it provides a consistent logic for stop placement, whether used in trailing exits, momentum setups, or institutional volume bands. Because the dynamic ATR buffer changes the physical distance between your entry and your stop loss, using a fixed share size on every trade results in inconsistent capital risk. To maintain a strict professional 1% account risk on every single trade, your actual share size must dynamically scale up or down relative to that ATR buffer distance. Here is the exact math for a $25,000 account. Your 1% risk is $250. If your entry is $100 and your ATR calculated stop loss sits at $98, the buffer distance is $2. Divide your $250 risk by that $2 distance, and your exact position size is 125 shares. This sizing algorithm allows you to risk the exact same percentage of capital on a hyper-volatile asset as you do on a sluggish blue-chip stock. This brings us to the final 5-step master protocol. Identify your anchor, measure the ATR, calculate the buffer, set the stop, and size the position. To access the full written breakdown of this strategy document and see live market applications, join our Telegram community using the link below. Professional risk management is about mathematically standardizing your exposure to the market's inevitable chaos.